All right, it is Wednesday, which means it is time for Mike on the Money. I think we need a little jingle or sound effect when it's time for Mike on the Money. The Consumer Price Index showed two prices rose 2.6% in the past year. That is up from 2.4% last month. So, of course, the question is, what does that mean for our money? Mike G in the place to be. Mike Giordano, financial advisor with Williams Wealth Management. As always, great to see you. So we all know that CPI showed the rate of inflation increased in the past month. And with that in mind, is that concerning?
Yeah, it looks like it could be concerning, right, that you went from 2.4% up to 2.6%, but it can be a little bit misleading. One of the biggest things is that you had a bunch of weak reports in the back half of last year, and so when you start to wipe those things off, it's easy to see how the rate could slightly go up. Now, if the trend went up for a few months in a row, that would really be concerning, and one of the big factors that everyone's been waiting for is for housing prices to come down, and housing was another big factor in the increase. So that is probably one area where it's probably taking a little bit longer than people are expecting.
And with today's inflation numbers, will that impact the Fed cutting rates moving forward?
Well, so today's numbers were actually expected. Even though the rate rose, the Wall Street economists were all forecasting that it was going to rise. So because it came in line with those expectations, it wasn't a big deal. The markets basically took it in stride. There wasn't much reaction. And so you actually saw that the market was basically pricing in even that the Fed will continue cutting here next month.
And now on the heels of the election, of course, a new administration getting ready to move in, I think the question is, will this impact inflation and the market as well moving forward?
Yeah, so the market's really conflicted. They're trying to figure out what's going to happen here with this new administration. Obviously, when Trump won, the markets were kind of betting that Trump was going to win, but the expectation wasn't necessarily that the Republicans were going to do a clean sweep. Once that all looked like it was going to be in play, the markets got really excited, the stock market in particular, in that it looked like, okay, that means that we'll probably get an extension of the tax cuts. That's good for corporate taxes, corporate profits, probably get lesser regulation. So all of that stuff's good for growth. Markets were real excited about that, and that's kind of what led to that surge last week that you saw. On the flip side, the bond market's been more concerned about some inflationary pressures. What about these tariffs? What about the mass deportations? Those types of things could be inflationary. So forget about what you think about the policies in general. Just from an economic perspective, the bond market's trying to sort out how much inflation these things could potentially cause. And the truth of the matter is right now, we don't know. We don't know what the policies are. We don't know the timelines on the policies. So there's still a lot to play out.
And you've got your glasses on, so I know you can see the investment outlook. How can we come up with a balance, as it's been a mixed bag lately?
I can see as far as my glasses are, but I can tell, and my eye doctor told me, he goes, you're in your 40s, Mike. Your eyes are going to constantly keep deteriorating here, and I can definitely feel it. So I can see well, and I can see you well enough, but I don't know if I can see all that perfectly. But yeah, from an investment standpoint, just like we mentioned, new administration, new policies, some things good, potentially some things could be, negative. It's hard to really tell, but what you want to look at is where are we in terms of an investment landscape? And you've seen massive returns here over the last couple of years. You've got a market that is priced pretty aggressively. You've got a lot of people that are uber excited. So this is not generally the time when you want to go all in, basically. And so the main thing that I've been talking about, not just today, but previous weeks, is simply that you want to have some balance here. You don't want to get so far outside of where you normally like to invest. So if your investment speed is somewhere in the 55, 60 miles an hour range, that's kind of where you want to be. This is not necessarily the time to say, let's just go all in on everything.
All right, Mike G, we appreciate the outlook. Thank you for helping us keep our pockets full.
I just want to let you know that my wife loves it when you call me Money Mike. She's like, it's totally inaccurate, but I love it.
All right, well, there it is. Thank you for letting me know that. I'll continue to do it. Money Mike, thank you for that outlook.